What's happening, guys, and welcome back to our channel. Getting pre-approved for a mortgage can be a crucial step in the home buying process, and here is how to get approved for a home loan or how to get a house loan. Number 5, improve your credit score and negotiate a reduced interest rate with creditors. The FICO score is used by every creditor to establish interest rates. Applicants may improve their FICO score by paying bills and dues on schedule. As a consequence, creditors will offer you a cheaper interest rate. Your credit score is affected when you have a credit card and use it to pay expenses. Paying your bills on time improves your FICO score, allowing you to get approved for the largest credit amount at the lowest interest rate. A FICO score of 620 or above is required by most lenders for a conventional loan, and some even demand it for a Federal Housing Administration loan. Customers with a credit score of 760 or above generally receive the best interest rates. According to FHA rules, qualified applicants with a credit score of 580 or above can put down as little as 3.5%. Those with weaker credit ratings will have to put down a bigger deposit. Lenders will frequently work with clients who have a low or somewhat low credit score and offer advice on how to improve it. At today's rate, a homeowner with a FICO score in the 620 to 639 range would spend $213,857 in principal and interest over the 30-year life of a $250,000 loan, while a homeowner with a FICO score in the 760 to 850 range would pay $132,216, a difference of more than $81,000. The Consumer Financial Protection Bureau's interest rate calculator helps you see how your credit score, loan type, property price, and down payment amount impact your rate. The tool is updated twice a week with current interest rates. Number 4, find a co-signer for the loan. Some people may not make enough money to qualify for a loan. That's why it's great if you can locate a co-signer with sufficient income. A large percentage of their salary goes to the monthly amortization, which may be enough to get you through it. Your credit score may potentially be compensated by a co-signer. In addition, if you have financial difficulties through the loan, the co-signer becomes your guarantee. When looking for a co-signer, make sure they're aware of the loan's terms and restrictions. Make sure you're aware of your mortgage legal requirements. Understand that if you miss a payment, the creditor will require your co-signer to pay. The creditor may demand the whole loan amount, which will have an impact on both of your credit ratings. As time passes, various economic conditions have an impact on the housing mortgage and creditors in the loan sector. If the economy suffers a downturn, creditors are more willing to make loans, which may work to your advantage. However, when the economy improves over time, it may be preferable for all borrowers to continue saving and purchase the home when the economy recovers. Borrowers must remember to improve their credit ratings, pay off their obligations, and save money throughout the waiting time. Also, pay attention to how the prices of different homes fluctuate, as well as the signs that indicate when you should start asking agents and canvassing the property you desire. Number 3, proof of asset. Bank and investment account statements are required to show that the borrower has sufficient funds for the down payment and closing fees, as well as cash reserves. The down payment, represented as a percentage of the purchase price, differs accordingly to the loan type. Unless the buyer puts down at least 20% of the purchase price, many loans require the buyer to acquire private mortgage insurance or PMI, pay a mortgage insurance premium, or pay a financing charge. Pre-approval is based on the buyer's FICO credit score, debt-to-income ratio, and other variables depending on the kind of loan in addition to the down payment. Except for jumbo loans, all comply with criteria set out by government-sponsored enterprises, including Fannie Mae and Freddie Mac. Some loans, such as Fannie Mae's Home Ready and Freddie Mac's Home Possible, are tailored to low to moderate income home buyers or first-time purchasers. Veterans Affairs or VA loans need no money down and are available to veterans, military members, and non-remarried spouses in the United States. A gift letter may be required by a buyer who gets money from a friend or family to help with the down payment to verify that the funds are not a loan. A mortgage pre-qualification can help determine how much a person can afford to spend on a property, but a pre-approval is far more beneficial. It implies the lender has evaluated the credit of the potential buyer and validated the documents to authorize a specific loan amount, typically for a period of 60 to 90 days. Consultation with a lender and receiving a pre-approval letter benefit potential purchasers in numerous ways. First, they will meet with the lender to review loan choices and budgeting. Second, the lender will do a credit check on the buyer to see if there are any issues. The maximum amount a homeowner may borrow will also be revealed, which will aid in determining the price range. Is your salary sufficient to meet the new mortgage payment and all of your other monthly expenses? This criterion asks. Lenders use your debt-to-income ratio to determine this DTI. Most lenders prefer a debt-to-income ratio of 36% or less, but the ideal ratio for you is the one you can comfortably afford. Number 2, look for various lenders. Some creditors reject a borrower's application, and this generally occurs to the borrower's initial creditor. Don't be disheartened though, as there are a variety of alternative solutions available. However, if your application is rejected by the second creditor you approach, something is wrong with your money and credit score. Before approaching another creditor, be sure you double-check this. When looking for a new creditor, don't give the impression that you're in dire need of money. This communicates to them that you should expect greater fees, higher interest rates, and a shorter repayment time. Furthermore, if you're a high-risk borrower, things may be different because costs may not affect you at all. When you realize that your dream house is closer than you thought, it's time to look for a creditor. CalSci Credit Union can assist you with home loan approval right now. The debt-to-income ratio calculator on NerdWallet will help you calculate your DTI depending on your existing loans and a potential mortgage. Borrowers with a DTI of 36% or less, including the mortgage, are preferred by lenders. However, it can be higher in specific situations. If you get a thumbs up during pre-qualification, the following step is pre-approval. A lender examines your credit score and reviews papers to verify your income, assets, and obligations throughout the mortgage pre-approval process. Number 1. Put money aside for a higher down payment. Your loan-to-value ratio will be lower the more money you put down on your property. This ratio compares the amount of your loan to the value of your home, and the greater it is, the more risk your lender is willing to accept. For a traditional mortgage, you should aim for a ratio of 80% or less, since this will increase your chances of not only getting approved, but also getting a good interest rate out of it. As a result, saving for a bigger down payment may be a crucial step in obtaining a mortgage. Another advantage of raising your down payment is that if you can come up with 20% or more of the buying price, you won't have to pay private mortgage insurance or PMI. PMI is a monthly fee that is added to your mortgage payment to protect your lender. However, because you're the one who pays for that protection, you're better off avoiding it. Purchasing a home is a major undertaking that will almost certainly necessitate the use of a mortgage. If you follow these steps, your home loan application will most likely be accepted, and you'll be able to lock in an interest rate that keeps your mortgage nice and cheap. So do let me know your thoughts regarding all of this in the comments down below, and I'll catch you guys later in another video. Bye now!